That One Future CPA podcast is produced by Beyond the Balance Media.
Tesla built its reputation on innovation. Autopilot, superchargers, stainless steel auto bodies, a future that looked like product design, not accounting entries. But behind that vision sat something far less glamorous: regulatory credits. Revenue Tesla earned not by selling vehicles or software, but by selling the right to pollute. Other automakers always fall short of their environmental standards, but Tesla doesn't. These companies are paying Tesla to bridge the gap. In some of these quarters, the credits turned a loss into a headline profit. In fact, in Q1 2025, Tesla recognized $442 million in regulatory credit sales. Net income for that same quarter was $409 million. What this means is that without credits, the quarter wasn't profitable. Tesla never led with that detail, and of course, the markets did not ask. But now the credits are collapsing, and the gap between narrative and number is no longer invisible. This is That One Future CPA podcast. My name is Christopher Dickerson. Let's talk about Tesla. Tesla built its reputation on innovation. Autopilot, superchargers, stainless steel auto bodies, a future that looked like product design, not accounting entries. But behind that vision sat something far less glamorous: regulatory credits. Revenue Tesla earned not by selling vehicles or software, but by selling the right to pollute. Other automakers always fall short of their environmental standards, but Tesla doesn't. These companies are paying Tesla to bridge the gap. In some of these quarters, the credits turned a loss into a headline profit. In fact, in Q1 2025, Tesla recognized $442 million in regulatory credit sales. Net income for that same quarter was $409 million. What this means is that without credits, the quarter wasn't profitable. Tesla never led with that detail, and of course, the markets did not ask. But now the credits are collapsing, and the gap between narrative and number is no longer invisible. This is That One Future CPA podcast. My name is Christopher Dickerson. Let's talk about Tesla. Tesla built its reputation on innovation. Autopilot, superchargers, stainless steel auto bodies, a future that looked like product design, not accounting entries. But behind that vision sat something far less glamorous: regulatory credits. Revenue Tesla earned not by selling vehicles or software, but by selling the right to pollute. Other automakers always fall short of their environmental standards, but Tesla doesn't. These companies are paying Tesla to bridge the gap. In some of these quarters, the credits turned a loss into a headline profit. In fact, in Q1 2025, Tesla recognized $442 million in regulatory credit sales. Net income for that same quarter was $409 million. What this means is that without credits, the quarter wasn't profitable. Tesla never led with that detail, and of course, the markets did not ask. But now the credits are collapsing, and the gap between narrative and number is no longer invisible. This is That One Future CPA podcast. My name is Christopher Dickerson. Let's talk about Tesla. Tesla built its reputation on innovation. Autopilot, superchargers, stainless steel auto bodies, a future that looked like product design, not accounting entries. But behind that vision sat something far less glamorous: regulatory credits. Revenue Tesla earned not by selling vehicles or software, but by selling the right to pollute. Other automakers always fall short of their environmental standards, but Tesla doesn't. These companies are paying Tesla to bridge the gap. In some of these quarters, the credits turned a loss into a headline profit. In fact, in Q1 2025, Tesla recognized $442 million in regulatory credit sales. Net income for that same quarter was $409 million. What this means is that without credits, the quarter wasn't profitable. Tesla never led with that detail, and of course, the markets did not ask. But now the credits are collapsing, and the gap between narrative and number is no longer invisible. This is That One Future CPA podcast. My name is Christopher Dickerson. Let's talk about Tesla. Tesla built its reputation on innovation. autopilot, superchargers, stainless steel auto bodies, a future that looked like product design, not accounting entries. But behind that vision sat something far less glamorous: regulatory credits. Revenue Tesla earned not by selling vehicles or software, but by selling the right to pollute. Other automakers always fall short of their environmental standards, but Tesla doesn't. These companies are paying Tesla to bridge the gap. In some of these quarters, this episode is not about stock price or politics. It's about accounting transparency. Under US GAAP, regulatory credits are recognized under ASC 606, revenue from contracts with customers. If you were here for the last episode, we talked a lot about ASC 605 for business combination, and today really looking at this revenue from contracts with customers. And they are recognized when Tesla satisfies a performance obligation that has nothing to do with the sale with the customer and everything to do with compliance. And this is where the numbers start to become a bit interesting, and we're going to get into them. For years, this revenue line masked operating volatility, right? Because it's very steady. So it makes it seem like revenue, income, and expenses are running steadily. But today we are going to ask, what happens when a company's narrative depends on a revenue stream that was never supposed to last? So let's really start to look at some of these numbers. Let's put them on a ledger, right? Let's open up some of these financial statements. Over the last decade, right, Tesla has generated more than $9 billion in regulatory credit revenue. That is a structural revenue stream for them. It's not accidental. It is not something that's incremental. It is deeply ingrained into their financial statements. Analysts have described this as quote unquote easy money, right? But easy money comes with expiration dates. We know that it's not going to last forever. And the expiration date is what's showing up in these disclosures that we are going to dig into. In Q3 2025, Tesla recognized $417 million in credits. A year earlier, it was $739 million. That is a 40% decline, give or take. And that's massive. That's why we're here today. That's why we're here to talk about this, because we want to shine a light on these credits, not only because they are such a large revenue stream for them, but also because they are declining, right? In Q1 2025, credits exceeded net income. In Q1 2025, credits exceeded net income. Without them, operating results would have looked vastly different. Investors are being coaxed, right? Being seduced by this idea of endless growth and that the financials were showing resilience. But in fact, these two things are not something that will persist, right? These are not truths that will continue as we're looking at these these financial statements for Tesla. And so we have to start asking ourselves, one, should the valuation have been relying upon something like regulatory credits? And two, if Tesla always knew that this business is shaky or that it wasn't going to be persistent, why are they relying so heavily on it? I mean, using regulatory credits to cross over from a loss to a net income is kind of crazy. But again, I don't think a lot of people have dug into the numbers enough to really see and understand what's really going on here. And so we're going to look at this valuation of Tesla and how the valuation itself is what is driving sort of some of these market moves with this company, and not so much the fundamentals. Maybe a little bit of investor FOMO, which I think is interesting. I just talked to one of my peers about this as I was walking up from class into the studio, and we were discussing how Tesla really is disconnected from the fundamentals. And in fact, you know, Elon Musk could get on an earnings call and say something, and it would move the market in a way that were disconnected to fundamentals, right? And so that's kind of the conversation that we're having here, because Tesla's valuation has soared past 1 trillion at its peak. Investors and the market were pricing in robo-taxis. They were pricing in autonomy at scale. They were pricing in this new energy storage sort of segment that they have. And they were also saying that these margins were going to expand, but the accounting reality behind all of that is a little bit less generous, right? If we're looking deeply into the statements, we can sort of see the cracks. As an accounting major, it's one of the things I find very interesting about the Tesla story is that, you know, in an academic standpoint, lots of people will say that, you know, the valuation is more like a tech company and not like an auto company, and it's a bit disconnected from the fundamentals. This is something that a lot of people know. They're just betting that they'll be able to deliver. So people will ask, like, you're having pricing pressure in Europe and China. I could talk about that all day long. Capital expenditures are accelerating to support factories on multiple continents, right? Gross margins are contracting as Tesla is prioritizing volume, right? So they're wanting to sell more of these cars, but the amount of money they're making per car is falling. All of these are headwinds, right? All of these are fundamentals that would show weakness, at least in the future outlook of the company, but the valuation of Tesla has held firm. And the question is why? It's because in valuation, this expectation of these credits make the company look a lot more profitable for a lot longer than they probably should have. And so the market has priced in the future before the present has existed to support it, right? So we don't have a lot of the tech that has been promised by Tesla. And again, this is larger than one person, right? That's why this isn't really about, Musk. It's not really about his politics. It's not even really about his leadership. It's more so about how the company has crafted itself to receive a high valuation that is disconnected from its fundamentals, but continues to promise these incremental technologies, these improvements in their tech and their products that is letting that valuation hold firm. But I will say this, these credits are falling. The valuation premium test, whether belief was built on fundamentals or subsidies, right? So if the credits are because the credits are falling, because the EV credits as well, and we're talking about regulatory credits, we're also talking about EV credits that are not supported by the current administration, that have been removed. So now we have to ask, is Tesla still valued at almost $1 trillion? Is the valuation still the same? Or will the market and analysts start to see these headwinds and start pricing them into the valuation? I would say it is a story that needs to be more closely watched and monitored. And in fact, it is ripe for accounting lessons and transparency. All right. So since a lot of us here are accounting majors, we're accounting professionals, we're business people, we're interested in some of these topics, we're going to get into them a little bit more. So here's where the mechanics matter, right? Regulatory credits are recognized under, as we mentioned, ASC 606 when control transfers to the buyer, typically another automaker satisfying an environmental requirement. What are we talking about here? Okay, so in California and in some other states, you can buy these like carbon credits, and basically it's like a credit against your carbon emissions. So if Tesla buys a lot of these credits and then sells them to other automakers, the other automakers will pay a premium for these credits because they don't have to actually comply with some of the environmental regulations, which is interesting because and this is not really where this podcast is going, but if Tesla and those who run Tesla really cared about the environment, then they wouldn't actually be selling these credits to other automakers. They would be behooving them to improve their standards so that we were all, making cars that are complying with these environmental regulations and not just buying credits so that you don't have to. But that is a whole other story. So 3 issues. The first one is sustainability. This revenue, sustainability of the revenue, not sustainability of the environment, which again is a conversation we could be having, but we're having a business conversation right now. But I would love to talk about the environment as well, because obviously the company, while it is an electric car company, is doing some things that are counterintuitive to its mission. But again, it's a business podcast. Sustainability of the revenue. This revenue is non-recurring and policy dependent, underlying policy dependent, because the EV credits that were federally supported are no longer supported, right? Also, if GM and Ford and some of the other automakers intensified the electrification of their fleet, then that means that they won't need the credits because they'll be complying with regulatory requirements. And so again, this revenue, is it sustainable? It certainly is not. Margin clarity is the second issue. Tesla reports credit revenue cleanly, but does not isolate credit margin. So they don't tell us, they tell us how much money they're making from selling the credits. They're not telling us how much they bought the credits for. And that's the margin, is the difference between how much you buy something for, how much you sell it for, that little margin in the middle. They're not telling us that. So we don't have full transparency. Profitability appears structural. It appears that like this is a profitable venture, these regulatory credits. However, we don't know this. The input is not clear. The margin is not transparent. And so you would wonder, you would ask, you would hope that analysts were looking deeper for more information here. The third risk is disclosure. Okay, another ASC 275 requires disclosure of risks and certain uncertainties that could materially affect results. Tesla notes that credit revenue will decline in the future, but growth narratives drown out this warning. Listen, a lot of times the market is speculative, so they're going to hear what they want to hear. You want to hear your thesis being confirmed. So if my thesis is that Tesla is $1 trillion tech company, and I hear, the CEO of Tesla get on here, or even the CFO, the CIO, the CTO get on here and say, this technology is coming here, that technology is coming, or we're proliferating this here, proliferating that here, then I'm like, yes, I'm the smartest guy on the street because this confirms my thesis. So it's not that this information is not being disclosed. It certainly is. But again, the market, the analyst, the street has priced it with one, hopes of what's going to happen, and two, sort of outside of its company class, right? It's definitely being valued like a tech company and very much not like a traditional car company. So I think what's interesting here is that the story that the investors are hearing that they want to invest in is so much louder than the actual facts or the fine print. As I mentioned, the market, especially from a retail investor standpoint, but again, I'm assuming from an institutional one because you could see it, there seems to be a bit of FOMO here. It's almost like the AI situation, which I think we could probably do an episode on AI as a bubble, not even just the societal cost of it, but the potential financial cost of what's happening with the bubble right now. But I think it's very interesting because it's clearly analysts and investors, the street, are not paying attention to the fundamentals. In fact, they may not even be paying attention to Tesla's own financial disclosures. They really want this to work. They want their investing thesis to be true. And I think you're seeing that in some of the behavior around the valuations. But there's a lot of changes coming up. And I think that's where we're seeing some of that shift in transition, at least in my thinking of Tesla and what it looks like 3 to 5 years down the line. So what happened? Policy, right? Policy changed in a number of places, right? So not just from a state standpoint or a local standpoint, but also from a federal standpoint. California has adjusted its zero emissions vehicle program. The federal incentives have evolved and are going away, right? The incentive to buy vehicles, international standards have tightened as well. So the buyers of Tesla's credits, these companies, are catching up as well. There's lots of stories, and I actually did want to do a deep dive into the economic impact of the cancellation of the EV credits because, GM was doing, over $1 billion of write-downs because of the efforts they were trying to do to electrify their fleet, and then they had to pull back because they're not getting some of that policy support from the administration. So yes, I actually think it's very interesting, to question, if Rivian is growing, if BYD is out there, if Ford, if GM, if Nissan, if they're electrifying their fleets, so they have to buy these credits as much? The answer is no, right? We already see this, right? We're seeing that credit revenue could fall by nearly 40% for 2025, and we're seeing that in the financials, so that's not a crazy number to think about. If I'm on the finance side of Tesla, or if I'm on the street, I'm looking at this and I'm thinking, where are they replacing this revenue from? Especially when you talk about how the credits were moving us from a net loss to a net income. That's a big deal. This is what we're seeing, right? We're seeing manufacturing costs that still need to scale, and people are very familiar with gigafactories. I'm a Texan, so I know that Tesla is down in Austin, even though I'm in North Carolina, but always a Texan. So I know that they're there. Gigafactories off in the desert in Nevada and Arizona, I believe. But still room to scale, right? Still room to get some of those efficiencies that come with growing. Battery expenses are tied to commodity cycles. There's a massive fight going on in the world around rare minerals, and a lot of that has to do with the materials that are being used in some of these next gen technologies, but certainly being used in battery packs. And so that's one of the considerations, right, is what does that mean as these commodity cycles, are moving through their natural motion? What does that mean for the price of the inputs? Competition is eroding the pricing power. And so that's what we talk about when we talk about margins, right? Usually when a company wants to sell more, they're gonna have to shrink their margins because they have to lower their price, but their costs don't go down, right? So it still costs you $100 to make the car, but now you're gonna sell it for $120 instead of $150. So yes, you might sell more cars at $120 per car. We're using easy numbers. You might sell more cars at $120 per car, but your margin has shrunk, right? So now you're only making $20 on that car instead of making $50 on that car. So volume in the place of margin is obviously something that Tesla has been thinking about, because they don't have the same pricing power, because especially BYD is eating their lunch in China and Europe, but even some of the legacy American automakers are electrifying their fleets. Let me, the camera shake here. I'm still getting used to this studio. But and lastly, innovation bets that were made unproven. We talked about Texas. I mean, Tesla is using some of their, we'll call it self-driving, I'm using quotes if you're just listening to the podcast, self-driving vehicles there in Austin, but they're very much bounded to where they can go. We're not seeing a massive fleet of robots being built. We're not seeing this energy storage segment really take off the way that they're wanting to. So listen, I mean, there are headwinds here. I'm not a Wall Street analyst. I'm just a grad student. I have a forecasting evaluations class. I could probably make a model for this, but I would tell you that my model is probably not going to be very optimistic because there are a lot of headwinds for the company. These subsidies are gone, right? They're gone. The credits that you get for people even buying the vehicle, right? Those are gone because of federal policy. So it seems as if Tesla's car business has to sort of stand on its own. And if Tesla's car business stands on its own without the wishful thinking of the CEO, what does that even mean? What does the valuation even look like? Is it almost $1 trillion company? Is it valued up there with other tech companies? Or is it simply an automaker fighting for market share and losing? So what happened? Policy, right? Policy changed. In a number of places, right? So not just from a state standpoint or a local standpoint, but also from a federal standpoint. So why does this matter, right? From an accounting standpoint, or maybe you're just interested in the way the market looks at these companies and evaluates them and how it thinks about revenue streams and things like that. So what does this mean? Tesla is really just a living case study in disclosure discipline, right? Credit revenue was valid, the accounting was compliant, but the interpretation was optimistic. The lesson is not skepticism, right? It's really just about separation. It's really just about trying to really understand the components of what's going on here. So let's have a quick little valuation lesson here. If you're trying to value a business, you do have to understand the different revenue streams of that business. You have to understand if those revenue streams will persist into the future, and then you have to really model in some headwinds. And certainly when I'm looking at Tesla as just, again, a grad student, a lowly little grad student, I must say grad student. When I'm looking at Tesla, what I'm trying to understand is, where is the revolutionary tech? Where are the new models? The product line is basically the same besides the Juniper, I believe, which is, it's fairly ugly, I'll be honest with you. And I've never really liked Tesla's cars from a visual standpoint, but even if you did, you have to be getting bored by now. They haven't changed the shape in a while. I just think that you have to sort of have a better understanding of what everything a company says it's doing and the value that those activities are bringing to the company as a whole. So that's what evaluation is really trying to understand, is to sort of break apart all the pieces of the company, understand what is driving them, especially from a revenue standpoint, but also from a cost standpoint, because we're talking about margins, right? So understanding what's driving those revenues, understand what's driving those costs, understand what's putting pressure on those margins, and then value that into the future if you think those will persist or if they'll get better or what have you. So yeah, they probably will still recognize some savings from economies of scale. I do believe that some of the technology will play out, but I don't know what this valuation looks like in 3 years, because I'm kind of just curious about the way the market and the street is looking at Tesla, either as a whole, as a story, as a product that exists. Like, I'm not sure. Let's do one more thing before we close. We want to separate the earnings from support mechanisms. We want to separate the demand indicators from compensation programs. We want to separate what the market wants to believe from what the financials can sustain, It's so important to understand that if the regulatory credit business in Q2 2025 knocked us from a loss to a net income, right? And that is an unsustainable portion of revenue, then we're in trouble. That sounds like trouble. It sounds like if the one thing, right? And I'm sure there's a lot of things, right? But if you look at that one segment, you have to say like, this one segment was approximately $400 and something million, and my net income was $400 million. Okay, that's interesting. And that segment goes away, but everything else stays the same. That's a loss. That's not me speculating. That's not me guessing. That's simple math. So yeah, I'm kind of curious when the optimism runs out. Accounting doesn't prevent optimism, right? The financials are there. They're looking at the financial statements. They see the same thing I see. They see the credit revenue going down. They know that is a temporary, all of that is there. So accounting doesn't mean that people can't be optimistic. It really should protect from assumptions becoming assets, right? Our assumptions should not become tangible assets on someone's income statement or balance sheet. It shouldn't, right? It can exist. And every growing company is priced at a premium, right? That's sort of like what the market does. But this valuation, it just feels so untethered from reality. And so you start having to question, like, you know what? Don't even question anything. Just keep your eyes open, right? Watch the stock, listen to the news, try to really understand what the future looks like for Tesla, what Tesla says the future looks like for them, and what the financials are saying looks like for them. And then ask yourself if those two are in juxtaposition with each other or are they complementing each other? I'm going to say juxtaposition. I'm pretty bearish on Tesla because I believe there will come a time where that valuation will hit the fan. The market will have to come to terms with what Tesla actually is and what the company can actually do, and then price that, not just price the story or the thesis that they want to be true. Alrighty, as we wrap up, it's very clear that Tesla has built a $1 trillion narrative on a revenue line item. And I know that seems a bit dramatic, but I think it's true, right? An entire narrative of profitability built on one revenue item, on one line item, on one FSLI, that's a big deal. I think people should be paying attention to that because these financials have to now deliver the belief that was priced in. We need to start seeing Tesla live up to this massive valuation. I don't personally want to see a bunch of robots in people's houses and at grocery stores and stuff, but that's what they're promising. Deliver it, right? I personally don't know how safe it is. Honestly, driving seems like one of the most dangerous things we do on a daily basis. Luckily, I live on campus and I don't have my car, so I walk all the time. But driving it seems incredibly dangerous. I don't know how safer or more dangerous that gets when you remove a human from the car, but you promised it, deliver it, right? Let us see what is being promised, and then the valuation would be, right, justified. We would be able to see like, oh, they are in all of these new segments, into all of these new businesses. All of this valuation makes sense. Right now, to me, it doesn't. So if the credits vanish and the profits don't remain, the adjustments won't just hit the statements, it will hit the story, right? Because then Tesla becomes a loser, a quarterly loser. And if Tesla is a quarterly loser, how does it keep its story? How does it keep its valuation? This is fascinating. This is fascinating. When I was a senior in high school, or I just graduated, it was the summer of 2008. So I graduated in 2008 from Chapin High School in El Paso, Texas. And that was right around the time that the market was going crazy and everything was happening. And I just felt really ignorant to what was going on. It was impacting me and my family, our finances, our financial security, but I had no idea what was happening. People that I knew, that I grew up with, didn't invest in the stock market. We certainly didn't teach us to invest in the stock market and didn't talk about it. So I just turned on CNBC and I started just listening and learning. And I just started trying to understand what all these words meant. Quarterly results and puts and options and trades and desks and commodities, all of these things. And I bring that up to say that I felt very intimidated by all of this information. But now, please, CNBC is like a second language to me. I can turn that thing on and I know exactly what they're talking about, and I can share it with other people. And so I would encourage you, if you're listening to this and you're not an accounting major, not a business major, but you're just curious, just watch, just listen, just take the time to be curious about some of the things. By the way, every company that's a publicly traded company has their financial statements on the internet. You can just literally go like Tesla financial statements, GM financial statements, McDonald's financial statements, and you can look at it and it's right there in your face, exactly what they're saying, exactly what they're doing, exactly what they did last quarter, what they think they're going to do next quarter. All the information is available. So arm yourself with the information that is in front of you, right? Use the resources that you have, CNBC, Gen AI to help you gather information, Google, right? Just do the work yourself. The thing I like about doing the work myself rather than using Gen AI is I usually find something that might be unrelated to what I was looking for, but still interesting. And I might go down a different rabbit hole, like a Wikipedia rabbit hole, but I won't get into that. But those are fun. Or you like click on an article, then an article, then an article, and now you're learning about ancient Mesopotamian art or something when you were just trying to figure out who was that actor you saw on 30 Rock. So I digress. All I'm trying to say is like arm yourself with information. That's the one reason why I really love doing this podcast. It's one of the reasons I love being an accountant is like I have access to all this information that's for free that someone is teaching me and then they're paying me to apply it. Yes, I will do that. So thank you so much for joining us for this episode of that One Future CPA podcast on Tesla. Our previous episode was on Warner Brothers, on Gen AI and Cracker Barrel. And there's also some articles on the Substack about how college booster clubs are the new activist investors. It's a really cool angle, of course, because I wrote it. I think it's a cool angle. You should read it. Might do a podcast on that as well. The next episode, we are going to ask the question of what happens when an entire sports ecosystem bets on itself. I think you might know where we're going. Once again, this is that One Future CPA podcast. My name is Christopher Dickerson, and thank you for joining us.